Hey guys, we're here with Jon Edwards, and we're going to talk about the CARES Act and the things you can do as an individual to apply for it and receive your benefit from the government.
Yeah, so this act came out and there's a lot of different provisions in it. So it's interesting to see what you can get out of it. So the first thing that we all know about is the stimulus checks. So okay. Most people, if you they look at 2018 and 2019 tax returns, okay, and whichever one's the most recent that you filed. So if you did 19, they'll look at that. And if you're an individual and you made less than $75,000 that year, you're going to get a check for $1,200. As a married couple, if you make less than $150,000, you'll get one for $2,400, so twice that amount. These amounts phase out, however. So if you make from 75 to 100, you'll get part of the 1,200. If you make it over that as a single person, you don't get anything. And then for a married couple, it's up to $198,000 you can make before it phases out. So that's the stimulus checks. It's pretty straightforward. And if you make more money in 2020, there's no requirement to repay it. That's put into the law.
So with the stimulus, as an individual, you don't have to apply. They're just going to be checking your records based on your income to see if you qualify. So there's nothing you have to do. You just kind of...
Yeah, most people have already gotten them about 2 weeks ago. Yeah. I think the paper checks are coming out. They should be mailed today or tomorrow. So there's still a few minor groups that are still expected to receive them. But for most people, they're going off the direct deposit information you put on your return for 2018 or 2019. If you don't have any, then you'll be part of the paper check group, which is yet to come out. So
okay.
They're trying to get the money out as quick as they can. So that's that part of the program. Also is the enhanced unemployment. So normally when somebody applies for unemployment, there's a 1 week waiting period. And this is usually all done individually by the states. That 1 week period is waived now, so the federal government will pay for that week. And they're adding $600 per week to the benefits paid by the states. They're also lengthening the amount of time that you can do it. So 13 weeks is now the max. There's some other stuff in this bill that's interesting. The student loan payments are going to be deferred up until September 30th.
So if you're a student, you have student loans, and you're still able to pay those loans, should you defer them or should you continue on your payment cycle?
That's a great question. No interest and fees are accruing, so I would just wait till September 30th.
Just wait, take advantage of it. Okay.
Now that's different, I would say, than the mortgage forbearance program that they've come out with. So right now, mortgage servicers have to offer you the forbearance option for 3 months, basically 90 days, if you wish to take that. And that's all well and good, but the problem with it is, at the end of the 3 months, you're going to have to make all the payments back up. So
you'll pay it regardless.
Yeah, you'll be making 4 payments in 1 month, which is going to be difficult, most likely, for most folks. And if you can't do it at that point, you're going to have to deal with the mortgage servicer's loss mitigation department and try to do a loan modification that they don't have to offer it to you.
Have fun with that.
They usually tell you need to be at least 30 days late before they can consider you, which means you're going to ding your credit. So there's a lot of pitfalls to this, and I think a lot of folks see it as something where I can just not pay my mortgage, and sure, why not? Who wouldn't want to just have the extra money? But there's a lot of downsides to it that I don't think people are really taking into account. But it's not like it doesn't affect anybody. Although these mortgages are guaranteed by government agencies like Fannie Mae and Freddie Mac, the mortgage servicer still has to pay the mortgage bondholder. And so there's been a lot of concern that this could become a larger mortgage meltdown. But recently there's been some more guidance that's come out that really says that the mortgage servicers are only required to front the funds for 4 months of non-payment. And then the federal government will step in and help from that point.
Okay, so as it relates to the mortgage forbearance, does this, I know the government's helping everybody out in a tough time right now, but could you foresee where they're not encouraging, but giving people the option to not pay their loans. And after this window of time, could you see this potentially pushing us into another downturn in the housing market by almost encouraging this?
Well, I mean, there was a lot of concern about that a few weeks ago, but there's been some additional guidance from the Fed and the Treasury as the weeks have gone on that have really solidified the problem, I think, a lot.
Okay.
One other thing I wanted to talk about, back to talking about the student loans.
Okay.
There also in the CARES Act, there's a provision where employers can now pay for an employee's student loan up to $5,250.
Wow.
And have that be tax-free. Previously, if an employer did that for you, you'd have to declare that as income and pay taxes on it. So that's kind of cool. Another thing in the bill is that you can take money out of your retirement account if you need to this year.
And tax-free too, right?
Yeah, basically normally if you take money out of an IRA or a 401k before you're 59 and a half, you have to pay 10% penalty in addition to any income taxes on the money.
And
that's waived.
So the penalty and the taxes are essentially waived?
Not the taxes.
Not the taxes.
The government relies heavily on those taxes, but they're letting you spread it over 3 years, which is nice. So that helps out.
But the 10% penalty is waived.
It's waived. Up to the maximum you can pull out is $100,000.
Okay.
And that's just for 2020. And technically, in order to do that, you need to have either had COVID-19, had a spouse who tested positive for it, or a dependent, or face some sort of financial hardship due to COVID-19. That definition to me seems
it's a little vague,
pretty broad. So I think a lot of people can say that they've been affected financially in some way from this.
I think everyone has on some level. It's hard to measure it, but
definitely. Another thing in there is that required minimum distributions are waived for 2020. Those are, once you turn 70 and a half, you're required to take money out of your IRA account every year for the rest of your life. So you don't have to do that at all for 2020 if you don't want to, and that should save a lot of our clients a lot of money on taxes.
That's great.
Also, if you have an inherited IRA, same thing applies. You don't have to take your 2020 RMD, and if you have an inherited account and you're currently taking a 5-year distribution of those funds, you can just ignore 2020 for that calculation as well. Another great thing is that taxes aren't due for 90 days, so instead of April, it's July 15th.
Yeah, they extended it.
One question I get a lot is, can I still make IRA and Roth contributions up until July 15th? Yes, you can, and same with HSA contributions for health savings accounts. So that's nice, gives us a little extra time.
That's great.
And that's when the taxes will be due as well. You don't have to pay interest from April to July. There's some changes also to the charitable deductions. So due to COVID-19, anybody can give up to $300 to a charity and not have to itemize their deductions, which is huge because they've raised the standard deduction so substantially that you can give $300 and it's an above the line deduction, so it comes right off the top. You're going to get credited back for that, which is great. Really helps to encourage charitable giving at this time. And but for federally, another thing to keep in mind for somebody who has a lot of charitable intent is that you can now, for 2020, you can deduct up to 100% of your adjusted gross income, whereas the cap is normally 60%.
Oh wow!
So you could eliminate all your tax liability if you wanted to give that much, rather than being capped at 60%. So it may not affect too many people, but it's good to be aware.
That's a big change and a good option for people.
So I think that's pretty much the basic things that I think are important about the CARES Act.
That's awesome. Thanks for that info, John.